Have you ever noticed how certain patterns return again and again, though the faces of the traders change? That is because the market is not new each day. It is a continuation of the same eternal laws playing out in different form. When you study the market with an open and disciplined mind, you will see that every movement has both cause and effect. A top is never made without preparation, and a bottom is never formed without accumulation. Time and price balance one another in every swing. When price travels too far without correction, time will bring the adjustment. And when time stretches too long without movement, price will provide the resolution. These are not coincidences, they are expressions of the law of vibration, the principle that everything moves in measured frequency and order. Do you watch how time and price interact, or do you only look at the bars without seeing their connection? Most traders see only numbers. The wise trader reads the story those numbers tell. Chart reading is the key to understanding this law. Every high, every low, every retracement leaves a footprint of the market's intention. If you plot these points carefully, you will find that price often moves in geometric relation to what has gone before. A previous high may become future resistance, a former low, future support. The chart is not merely a record of the past. It is a map of probable future action. When you learn to read it, you can often forecast turning points with remarkable accuracy. But this skill comes not from guessing, but from studying and applying natural order. The market obeys geometry, proportion, and timing. Those who align their trades with that order will find the market far more predictable than they once believed. The reason most traders fail to see this order is impatience. They want results quickly and chase after every small fluctuation without waiting for confirmation. But the market does not reward haste, it rewards observation. The trader who studies the daily, weekly, and monthly movements with patience begins to see the repetition of price behavior, the recurring formations, the rhythm of advance and decline. He understands that a market trend is like a tide, it rises and falls in waves, each connected to the last. Do you take time to mark your charts, to compare present movements with past ones? Without that habit, a trader is like a sailor at sea with no chart to guide him. When I first began studying the markets, I too believed they were controlled by chance and sentiment. But after years of recording prices, plotting charts, and comparing time intervals, I found that the same conditions repeated with mathematical precision. Certain angles and ratios governed the movement of price, certain dates coincided with turns. I saw that the market was not a wild beast, but a living organism moving according to natural law. Once you see that your entire view of trading changes, you no longer fear the market, you begin to respect it as a teacher. The swings that once seemed violent now appear measured. The panic of the crowd becomes an opportunity to act when law tells you the time is right. Each market instrument has its own rhythm, just as each note in a musical scale has its own vibration. Wheat does not move like copper, and copper does not move like stocks. Yet all obey the same universal law. The trader who understands this can adapt his method to any market, because he looks for rhythm and proportion rather than mere price quotes. He knows that a chart is a living thing, a record of energy moving through time. Have you ever compared the cycles of different markets and seen how they often turn together or in opposition? The law that governs one governs all. There is beauty in this order if you have the patience to see it. A market rise is not random, it unfolds in stages, each marking a step in the natural progression of accumulation, advance, distribution, and decline. Within each of these larger movements are smaller cycles, just as the tides contain waves, and the waves ripples. The trader who recognizes these nested patterns can position himself where probability favors him. He does not fight the law, he works with it. He knows when the time is right to buy and when it is right to sell, because he understands that every market movement has its season. Have you noticed that markets often turn at the same time of year or after similar time spans? That is time at work bringing balance to price. To trade successfully, you must train your eye to see the relation between price and time. Mark your charts with the intervals between highs and lows. Measure the distances traveled and note the time taken. You will begin to see ratios repeat, 1, 2, 1, 3, 1d4, relationships that occur not by coincidence but by natural proportion. Time and price are twins when they reach equilibrium. Change is due. The man who learns to identify that balance can forecast turning points with precision that others mistake for luck. Do you ever study the time between major tops and bottoms, or do you focus only on the last bar that printed? It is in those intervals that the truth hides. The law of order in markets also governs the trader's own conduct. Just as price and time must balance, so too must action and patience. A trader who acts out of rhythm with the market is doomed to fail. Success comes from harmony, from aligning your trades with the rhythm already present. You cannot rush the market any more than you can rush the seasons. Planning your week around this principle gives you an edge. It teaches you when to trade and when to stand aside. Every profitable week I have ever had was the result of trading in harmony with the prevailing cycle, not in defiance of it. When you study charts long enough, you begin to sense the pulse of the market. You see that its movement is alive, orderly, and deeply connected to the passage of time. The chart is your window into that order. It speaks a language that is silent but exact. Those who ignore it are blind to the law that governs their own success. But those who read it faithfully, and who respect the harmony between price and time, will find that the market rewards their understanding with clarity and consistency. And from that understanding, a profitable week becomes not a matter of chance, but the natural outcome of working with the rhythm that has always been there. Preservation of capital is the first law of trading. Without capital, no trader can survive long enough to learn, to grow, or to profit. Every man who enters the market dreams of gains, yet few think of defense. But trading, like war, is not won by attack alone. It is won by knowing when to protect what you already have. The trader who makes it his first duty to preserve his capital will always outlast the one who chases quick fortune. Do you ever stop to ask yourself how much of your trading week was spent defending rather than attacking? That simple question often reveals the difference between a professional and an amateur. A trader's capital is his lifeblood. It is not just money. It is the means by which he expresses his judgment and tests his skill. When you lose it through carelessness or impatience, you lose the very tool that allows you to recover. The man who keeps his capital intact can wait for the right conditions. The man who loses it must trade from desperation, and desperation is never a sound strategy. Capital, once gone, is difficult to rebuild, and every unnecessary loss takes away more than dollars. It takes confidence, clarity, and patience. Have you ever felt the strain of trading after a heavy loss? That is the true cost of violating the law of preservation. Preservation begins not with the size of your account, but with your understanding of risk. Every trade carries uncertainty, and no trader can control the market's movement. But you can always control your exposure. That is the art of survival. The disciplined trader decides in advance how much of his capital he will risk on a single trade. Never so much that one mistake can cripple him. Those who ignore this rule may win for a time, but sooner or later the market catches them off guard. The man who risks recklessly may make great gains, but he also courts great loss, and one loss too large can end his trading career in a single week. Do you know the exact percentage of capital you risk on each position? Or do you simply trade what feels comfortable in the moment? The market has no mercy for those who trade by feeling instead of measure. Capital preservation also means knowing when not to trade. There are times when the market offers no clear opportunity, when prices are erratic and trends uncertain. The wise trader stands aside during such periods, conserving both his money and his energy. The inexperienced trader, fearing to miss out, throws himself into every minor move, only to lose small sums again and again until his account is drained. Standing aside is not weakness, it is strategy. The man who can wait for the right time to act is always stronger than the one who cannot stop acting. Patience is a form of protection, and every preserved dollar is a potential bullet for the next opportunity. Another key to preservation is learning to accept small losses quickly. Too many traders let a small loss grow into a disaster because they cannot admit they are wrong. But in trading, small losses are not failure, they are insurance. A small, controlled loss keeps your capital safe so that you may fight another day. The trader who refuses to take small losses eventually takes a large one. Have you ever held onto a losing trade, telling yourself it would turn around, only to watch it sink further? Every trader has, and every trader who survives learns the lesson: your first loss is your best loss. Capital preservation also depends on the control of emotion. Fear and greed are the great enemies of the trader. Fear keeps you from taking the right trades, while greed drives you to overtrade or over-leverage. Both emotions are destructive to capital. A trader who protects his capital must protect his mind first. You cannot think clearly when emotion rules you. The market is a mirror, and it will always expose impatience, ego, and recklessness. The trader who guards his emotional balance as carefully as his account balance will always be prepared for opportunity when it comes. Do you notice how your emotions change after a loss or a gain? Awareness of that rhythm is part of your capital defense. Diversification is another shield for preservation. Never place all your capital in one market or one idea. Spread your risk intelligently, and you will survive even when one market behaves unexpectedly. Just as a farmer plants several crops to guard against a bad season, a trader should not depend on a single position or method. Preservation is not about avoiding risk entirely, it is about managing it wisely. The market will always have periods of uncertainty, and the diversified trader can ride through them with stability. The law of preservation extends beyond individual trades. It governs the entire rhythm of a trader's career. You cannot expect to profit every week. Some weeks are meant for learning, for analysis, and for preparation. Forcing profit when the market offers no clear opportunity is a violation of this law. The trader who understands preservation knows that there is a time to grow and a time to hold steady. By keeping his capital intact during the slow periods, he is ready when the strong trend returns. Do you ever feel compelled to trade simply because the market is open? That compulsion is the enemy of preservation. Capital protection is also about controlling expenses and managing leverage. Many traders destroy themselves not by market losses, but by trading too large for their account or paying unnecessary costs. Every dollar saved through discipline adds to your staying power. The longer you can remain in the market, the greater your chances of success. Trading is not a race, it is a test of endurance. The market rewards those who last. The small trader who respects the law of preservation can outlive the large trader who ignores it. To preserve capital, you must think like a general in battle. Plan your advance, secure your retreat, and never fight on ground you do not understand. A wise trader never risks his main force on uncertain conditions. He probes the market with small positions first, testing its strength. Only when the market confirms his analysis does he commit more. In this way, even when he is wrong, his losses are light. Preservation is not cowardice. It is strategy born of experience. When you learn to preserve capital, your entire trading outlook changes. You begin to trade with patience, confidence, and clarity. You stop chasing every move because you understand that opportunity will always return. The market will always offer another trade, another swing, another setup, but you can only take advantage of them if your capital remains intact. Capital preservation is not about missing out. It is about ensuring that you are still standing when the next real opportunity comes. Patience and timing are the true foundations of profitable trading. Many traders think success depends on constant activity, but that is not so. The market rewards precision, not motion. The man who trades less but at the right moment will always outdistance the man who trades every fluctuation without purpose. Patience is not waiting idly. It is the art of preparation, the discipline of holding back until price and time align in harmony. Timing is the skill that allows you to act in that perfect instant, not too soon, not too late. Have you ever noticed how the greatest opportunities appear only for a brief moment, and then they pass? That is the market's rhythm, and the trader who learns to move with it finds himself in step with profit instead of chasing it. A trader without patience is like a farmer who tries to harvest before the crop has ripened. He may work hard, but his effort is wasted. The market has seasons, and every price move unfolds in stages. Accumulation, advance, distribution, and decline. You cannot rush these stages any more than you can rush the growth of a tree. The trader who waits for confirmation, who studies the structure of price before acting, gains a great advantage. He does not buy simply because the market is rising or sell because it is falling. He waits until time and condition agree. Do you enter trades because you see movement, or because your analysis tells you the right time has come? That small distinction makes the difference between a lucky trader and a consistent one. Timing is not luck, it is calculation and rhythm. When a trader sits down at his desk at the start of a new week, his first thought should be not of how much he hopes to make, but of how he plans to protect what he has already earned. I have always said, speculation is as old as the hills, and the principles that govern profit and loss are as sure as the sunrise. Do you ever find yourself chasing the market, trying to force it to give you something it's not ready to give? That is where most traders stumble, not from lack of opportunity, but from lack of discipline. The profitable week begins long before the first trade is made. It begins with right thinking. Every man who trades must first learn to read the language of the market. The chart tells its own story if you have the patience to listen. When prices swing up and down, when they form tops and bottoms, there is rhythm there. A law, not chaos. The market is not moved by chance. It is moved by natural law, by the same order that governs the tides, the planets, and the seasons. Have you noticed how markets often repeat their movements after a fixed interval of time? That is no accident. It is a sign of cause and effect working out in price and time. To have a profitable week, you must not fight these forces, but move with them. Too many traders enter the market without a definite plan, hoping fortune will smile on them. I've seen it 1,000 times. But hope is not a trading plan, knowledge is. The man who knows where a trend begins and where it ends can act with confidence. He does not guess, he calculates. He studies past movements and projects them forward, knowing that what has been will be again, in some form. Do you ever make a trade without knowing exactly where you'll get out if you're wrong? That single mistake can turn a week of profit into a week of regret. Always decide in advance what your risk is, and let no excitement tempt you to change it once the trade is made. The profitable week is not measured by the number of winning trades, but by the quality of decisions made. If you make only 2 trades, and both are based on sound reasoning, you have done better than the man who made 10 impulsive ones. I learned long ago that it is better to miss a move than to make a wrong one. The market is eternal. There will always be another opportunity. Have you noticed how the market rewards patience, yet punishes haste? That is one of its oldest laws. Each week brings its own vibration, its own tone. Some weeks move with energy and strength, others drift in dullness. The wise trader adjusts to that rhythm. You cannot trade all markets the same way, just as you cannot plant seeds in winter and expect harvest in spring. Time governs all things, and time, when understood, will make a trader master of his craft. The profitable week comes when you are in tune with that time, when your trades are placed not by emotion, but by knowledge of timing and cycles. Let me tell you something I learned through long and costly experience. The mind of the trader is his greatest asset and his greatest enemy. A chart can show you the truth, but if your mind refuses to see it, you will still lose. Do you keep a record of your trades? Most men do not. Yet the chart of your own trading is more important than any market chart. Study your mistakes with the same care you study prices. If you can learn to correct yourself, the profits will take care of themselves. There are weeks when the market tests you. When every signal seems false and every plan fails, that is when character is built. It is easy to trade well in favorable conditions. It is the difficult times that make the trader. The profitable week, therefore, is not only one of monetary gain, but one where you have gained mastery over yourself. Have you ever noticed that your greatest losses come when your emotions take the lead? The market can sense fear and greed. It feeds upon them. In all my years of trading, I found that the most successful weeks were those when I was calm, patient, and balanced. I did not try to take every swing. I waited for the market to come to my levels. If a man will wait for the exact time when conditions align, price, time, and volume, he will often find that the trade almost takes itself. You can call it intuition, but it is simply trained observation, the result of study and discipline. Do you give yourself time to observe, or do you jump in at the first sign of movement? The profitable week is not made in a single lucky trade. It is built day by day, just as a building is raised brick by brick. Each trade should have purpose. Each entry should be measured. Remember, it takes only one careless decision to destroy the work of many wise ones. Guard your capital as you would guard your life. Without it, you cannot trade another day. Many traders speak of profits, but few speak of preservation. Yet preservation is the secret foundation of all enduring success. The man who keeps his losses small can survive long enough for fortune to favor him. When the market gives you a gain, take it with gratitude and without greed. Have you ever given back your profits simply because you hoped for more? I have done it myself, and it was a costly lesson. The market teaches humility to every man who ignores its laws. In every profitable week, there comes a moment when the trader must decide to stop. That is as important as knowing when to start. When your calculations show the move has reached its natural limit, when price and time square, that is the time to step aside. The trader who knows when not to trade is often the one who ends the week in profit. Now, let me say this: trading is not gambling, though many treat it as such. It is a science, an art, and a mental discipline. Each week, you are not merely trading prices. You are measuring the balance between order and chaos, between knowledge and emotion. The chart is your instrument, but your judgment is the key. Do you trust your analysis, or do you let the crowd sway you? The profitable trader does not follow the crowd. He follows the law of vibration, the natural rhythm that governs all price movement. To have a profitable week, you must think in terms of probabilities, not certainties. There are no guarantees in this business, only calculations and controlled risks. The man who accepts the truth becomes steady, while the man who seeks perfection becomes reckless. Accept losses as part of the cost of doing business, but let them be small and instructive. A week that teaches you something valuable, even through loss, may in truth be more profitable than one of easy gain. Every candle on your chart is a record of human behavior, of fear, hope, confidence, and despair. The market is not impersonal. It mirrors the collective emotion of men. When you study the charts, you are studying human nature itself. And the man who can understand human nature, especially his own, will always have an advantage. Have you noticed that the market seems to move against the majority just when they become most certain? That too is law, the law of balance, of correction. And so, as you look back over your week, do not measure your success by dollars alone. Measure it by how closely you followed your plan, how calm you remained under pressure, how well you obeyed the laws of time and price. If you can say you traded by rule, with patience and understanding, then your week has been profitable, whether your balance shows it yet or not. For in trading, as in life, the profit that endures is the profit of wisdom gained and discipline mastered. A profitable week in trading does not come by accident or luck. It is the direct result of careful preparation and disciplined planning. Every man who enters the market must understand that success is not born out of chance, but out of method. The trader who approaches each week without a clear plan is like a ship sailing without a compass. He may drift for a while, but the first storm will break him. A profitable week begins long before the first trade is ever made. It begins in the trader's mind, in his preparation, and in his quiet study of the market's behavior. Do you plan your trades each week, or do you simply react to what the market does? That single choice often separates the consistent trader from the careless one. Planning is the act of defining what must be done and when to do it. In trading, that means studying the chart, identifying support and resistance levels, observing cycles of time, and knowing the prevailing trend before the week begins. I have often said that the market will always tell you what it intends to do if you will take the time to listen. But too many traders begin their week with emotion, not observation. They chase prices, buy because others are buying, and sell because others are fearful. That is not planning. That is following the crowd, and the crowd is almost always wrong. Have you ever noticed how the market tends to move opposite to what the majority expects? That is because few take the time to study and prepare. Discipline is what makes a plan live. Without discipline, even the best plan fails. Every profitable week comes from following a set of definite rules. When to enter, when to exit, how much to risk, and when to stop trading. The rules are not there to limit you, they are there to protect you. When you have a plan, your emotions no longer control your actions. You act from calculation, not from hope. And hope, my friend, is the trader's most dangerous enemy. Hope will tell you to hold a losing trade a little longer, just in case it turns. Hope will tell you to double your position after a loss, to win it back quickly. Hope will whisper that the market must turn in your favor. But the market obeys no man's hope. It obeys law and order, and those who do not plan around that law pay the price. Before the week begins, a wise trader looks at the market's past movements and identifies where opportunity may lie. He studies the previous highs and lows, the time cycles that govern turns, and the volume that confirms strength or weakness. He knows that a profitable week is not made by reacting, but by anticipating. Have you ever watched how the great traders always seem to be ready before a move begins? That is not luck. That is the fruit of preparation. They know what they are looking for, and when the market gives it, they act without hesitation. The trader who plans knows exactly where he will enter a trade and where he will get out. He knows the price that proves him wrong and the price that confirms him right. He measures his risk before he takes it, and he accepts that risk as the cost of doing business. There is no guessing, no hoping, no chasing. If the market does not meet his conditions, he simply does not trade. Many think that standing aside is weakness, but in truth, it is one of the greatest strengths a trader can possess. The man who knows when not to trade will always preserve his capital for the right opportunity. Do you set your levels before the week begins, or do you decide them after prices have already moved? That small difference can turn a winning week into a losing one. A profitable week is also a reflection of how a trader manages his time and his energy. Trading is not about watching the market every minute of the day. It is about watching it with purpose. A plan allows you to know when to act and when to wait. It keeps you from overtrading, which is one of the greatest destroyers of profit. When a trader has no plan, he feels the need to trade constantly, as if movement alone creates profit. But the market rewards precision, not activity. One well-planned trade, entered at the right time, is worth more than a dozen impulsive ones. Planning also protects you from the greatest danger in trading, your own emotions. When you plan your trades, you take decisions in a calm state of mind, before the heat of the moment. You decide in advance how much you will risk, so when the market moves, you are not swayed by fear or greed. You already know what to do, and you simply follow through. That is the essence of discipline, acting according to your rules even when every emotion urges you to do otherwise. Have you ever noticed how your best trades are often the ones you entered calmly, and your worst trades the ones you entered in haste? That is no coincidence. Planning keeps you calm because it gives you control. Each week in the market is a test, not of the market itself, but of the trader's ability to apply his own rules. Those who plan their work and work their plan find that the market begins to make sense. They can see patterns forming, anticipate turning points, and act with clarity. Those who refuse to plan, however, drift from one trade to the next, never quite understanding why they win or lose. The profitable week belongs to the man who knows what he is doing and why he is doing it. There is a rhythm to trading that mirrors the rhythm of life. Preparation, observation, execution, and rest. These are the 4 phases of every successful trading cycle. Planning ties them all together. Without planning, there is no rhythm, only reaction. The trader who enters the week without a plan will always be chasing the market instead of leading it. And the man who chases will always be one step behind. Have you ever noticed how those who plan seem to have time on their side, while those who don't are always too late? That is the natural reward of discipline. Time works for the prepared. A profitable week therefore, is not an event, it is the consequence of steady preparation and self-control. It begins with analysis, continues with execution, and is maintained by emotional balance. The trader who makes a plan and follows it with discipline does not need luck to succeed. He has aligned himself with law, and law will always favor order over chaos. But planning requires humility. The humility to accept that you cannot control the market, only your actions within it. Each week, the disciplined trader reviews his plan, refines it, and prepares again, knowing that the market will always reward the man who respects its laws and prepares with care. The market moves according to law, not chance. Many traders call the swings of price random, but that is because they do not take the time to study their rhythm. Price and time are not strangers, they move together in harmony, governed by natural law just as surely as day follows night. When a trader learns to read that rhythm, he discovers that what others call confusion is in fact order. The profitable trader does not see chaos in the market. He sees structure, sequence, and repetition.